Hello and welcome to another episode of Pakistanomy. My name is Zaheer Yunus, and today we're going to be talking about how and why access to credit in the private sector is important for sustainable growth, innovation in the economy, sustained job creation, and everything else good that Pakistan's economy needs and has been needing for a long time. Joining me to talk about this today is Namoos Zaheer. Namoos is a senior financial sector specialist who works in the finance, competitiveness, and innovation global practice in the World Bank, and has written recently about financing private sector led growth in Pakistan. And so I figured we would have Namoos to dive a bit deeper into what she's seen, the research she's conducted, and how does Pakistan unlock private sector led growth through access to credit. So, Namoos, welcome to Pakistanomy, and thanks for taking out the time today.
Thank you. Thank you very much. Very happy to be here.
I want to start with, let's give our audience a basic understanding, high level econ understanding of why capital markets are an important player in unlocking growth, and how does this mechanism work, and why is it that economists, finance experts, capital market experts continuously stress the need for enhancing access to credit to ensure growth in an economy.
Great. Thank you. So I'll actually kind of take it a step back and I'll talk about the financial sector's role in promoting growth. And then, because the capital markets are one part of the financial sector. So you have what we call when you look at the banking sector, you have the financial sector, you have the banking sector, and then you have what is called the non-bank sector, which includes things like capital markets, insurance companies, pension funds, venture capital, private equity, things of that nature. Pakistan is very, very bank centric. So our financial sector is, close to, I think, 78% bank dominated. So the capital markets in Pakistan are extremely underdeveloped, like most of the developing world and peer countries, even in South Asia. I think only India is the one who has a relatively vibrant capital market. But if I were to just address the issue as to why the financial sector is important, let's just say that the financial sector, maybe because I work in the sector, I'm going to give it undue importance. But I think most economists would agree with me that the financial sector in many ways is the nerve center of any economy. It intermediates savings for investment. That's basically the fundamental role of the capital markets. What we're seeing, of the financial markets, and what we're seeing in Pakistan is that the dominant borrower from the banks is the government. So the intermediation chain has broken down because all of the savings, whether they're coming from depositors, whether they're coming from pension funds, whether they're coming from insurance companies, they're flowing directly to the government. And as we know, the government, while it obviously needs these funding to finance its growing fiscal gaps, it crowds out the opportunity of the private sector to borrow from the banks, as it were. I was actually just looking at some statistics because I wanted to kind of give you guys an understanding of where Pakistan stands on this. So Pakistan's credit to GDP, private sector credit to GDP ratio is about 17%. It's never really gone above, I would say the top it ever reached was about 25%. If you look at neighboring India, for example, their private sector credit to GDP ratio is closer to 60%. Bangladesh is 40%. And then you have Malaysia, which is obviously something that Pakistan economists always aspire to in terms of our growth paradigm. That's closer to about 130% of GDP. So obviously, for the financial sector, for the private sector to flourish, it needs access to credit. Unfortunately, because of the macro situation in Pakistan, the government's borrowing needs keep growing. So that further crowds out the private sector's access to credit. And even within the private sector, I should kind of highlight the SMEs are completely squeezed out. So of this 17%, I think SME finance is less than 1% of GDP. And the backbone of any economy is the SME sector. Again, if you look at neighboring countries, Bangladesh, India, the numbers are closer to or above 10%. So that in Pakistan, in the growth paradigm, I think is one of the fundamental problems that we're having is that we are not getting access to credit to entrepreneurs, like, the young folk increasingly who need access to credit. They're being crowded out because whatever little credit is going to the private sector is going to the big wigs. It's not necessarily going to the SME sector. So that's why I think, so just to kind of recap, it is the intermediary between savings and investment. And if that breaks down, then you're not going to, your money is not necessarily going to go towards productive investment, which is unfortunately what we're seeing in Pakistan.
So based on that explanation, would it then be fair to say that because the sovereign consistently essentially offers amazing risk-free returns, and because the sovereign offers amazing risk-free returns and its appetite for borrowing continues to grow, the banking sector essentially gets lazy, right? Because if you're sitting, is that the fair assessment to say that they're kind of lazy? They're like, hey, the government of Pakistan will next year run an 8% fiscal deficit. I'm just going to lend to it and I can just go play golf because the sovereign will always pay me. Why bother with these small SMEs who need hand-holding? There may be risk, there may be all sorts of other issues. And so let's just lend out to the sovereign and go play some golf.
Well, it's ironic that you mentioned golf in particular, because when I first started working on Pakistan's financial sector about 5-6 years ago, I went and met with the big banks and tried to fully understand this, because this was a very alien. I came from investment banking in London, where so this was a very alien concept to me, that the banks are not trying to increase their depositor base, they're not covering clients, So I wanted to kind of understand what's going on in this space. And this is exactly what he was. I will not name any names or anything, but he was the head of a very big bank in Pakistan. And this is exactly what he said to me. He goes, we are not a development institution. We are not the World Bank or anywhere ADB or anyone multilateral looking to, have developmental impact. We are answerable to our shareholders, and we make a lot of money just lending to the government. So I can go and play golf at 3:00, and those are exact words. That if I can go play golf at 3:00, resting easy, that I'm going to make money lending to a risk-free borrower, then why wouldn't I do it? So it is. I mean, you could call it lazy banking. Yes, you can't really blame. I mean, if you look at the profits of the banks over the last 2 years, when Pakistan has actually economically been in dire straits, the banks have been extremely profitable because the interest rates have been going through the roof. That is most definitely the case. But one thing I think, which I think is interesting to note, is that this is what we call the sovereign bank nexus, right? Where the health of the banking sector is very, very intertwined with the health of the sovereign, right? And that's what we're seeing in Pakistan, because the banks are so exposed to the sovereign. I believe about close to 70% of their lending and assets is to the government of Pakistan. Any distress to the sovereign will very quickly translate into distress to the stability risk to the banking sector. I mean, this is what we're seeing in Sri Lanka. And Sri Lanka, the banks are not even as exposed as Pakistan. The banks, I think, there are between 40% or 40 to 50% of their assets are to the sovereign, but because their sovereign, has exhausted all channels of external financing, and their macroeconomic situation is clearly a lot more, dire and fragile than Pakistan. But there, there is a very real risk of a full-blown stability issue. And, in Pakistan, I think for the first time, the only blessing in all of this may be that for the first time, banks are actually thinking, oh, wow, the sovereign is not necessarily a fully risk-free borrower, right? And this is something that we have been trying to tell them as the World Bank, for a long time, because prudentially, if I get slightly technical, so after the financial crisis of 2007, where the subprime mortgage exploded, right? At that time, there was an overhaul of prudential regulations and risk ratings and capital adequacy ratios, because there was a recognition that banks are not effectively recognizing their risks, and they're not creating the right kind of buffers that in case there is a distress in specific markets, they don't have the balance sheets to absorb that risk and they go insolvent, like we saw with Lehman's, which was, unprecedented. So then they made a lot of allowances in terms of, liquidity buffers, you had to risk rating of depending on the type of borrower, so that you had enough capital in reserve so that if there were NPLs in that area, you could kind of absorb it. But even in that space, the sovereign was considered to be risk-free, right? So what we're seeing is in Pakistan, the capital adequacy of the banks is well above the minimum requirement. I think the minimum requirement in Pakistan right now is about 11.5%. I think banks here are closer to 16, 17%. So they're well above it. But if you think about it, because these buffers are just for their lending to the private sector, which, as I said, is a very small proportion of their lending. So in reality, the banking sector is very exposed to the sovereign, and sovereign distress can very quickly translate into issues in the banking sector. And these are things which, I think the only kind of maybe silver lining in all of what we're seeing economically in Pakistan, I think there's an increasing recognition in the banks, in the state bank itself, that we cannot, treat the sovereign as a definitive risk-free borrower. And this, may then hopefully break some of the inertia in the lending, and maybe bankers will start playing a little less golf. That maybe we can only hope.
On the Lehman Brothers note, like one thing, I was in undergrad at that time, and I vividly remember the day Lehman went under. We were hanging out in the cafeteria watching CNBC, and people taking out their computers and all of that. It's like etched. It's one of those days that's etched in my memory as a young student in undergrad studying economics. The one thing that I remember from that also is that there was this essential view that there were quasi-sovereign guarantees as well, right? Things like Freddie Mac, and Fannie Mae, etc. The market believed that, yes, they were private, but the state stood behind them, and there was this kind of like gray area. In the Pakistani context, something I've seen, and Adil Mansoor, who follows the agricultural sector, came a year or so ago and basically explained that you have commodity debt in the commodity cycle in Pakistan, which is quasi-sovereign, where the sovereign essentially is now borrowing to make interest payments, close to over $1 trillion rupees at this point in time. Where does that understanding in the banking sector of the quasi-sovereign debt and the SOE debt stand? Is that considered fully sovereign as well in terms of their analysis of capital adequacy ratios, etc., or is in Pakistan, is that the same problem, that it's kind of like in the middle where nobody knows how to treat it?
So I mean, I'm not sure, but I think most of this debt has an implicit sovereign guarantee, right? If you're lending to an SOE, or if you so there is, and particularly on the commodity debt, it is presumed that the sovereign will backstop it. But I think one thing notable, like for example, because I actually just moved to London the week Lehman happened, and I went in consulting to PwC, and my first job was actually to go to Lehman Brothers, London, Canary Wharf, and kind of sit through there, because they had open trades which weren't settling, so we had to manually sit and go and do that. So it was a very, very distressing and disturbing scenario. But having said that, at that time there were many banks that should have failed. It just wasn't Lehman, right? A lot of them were bailed out in a very, very big way by the governments. But in the Pakistani context, because of the sovereign debt nexus, one thing to keep in mind is that the sovereign, if there's sovereign distress, the sovereign doesn't have the fiscal space to bail out anyone, right? The banks are in trouble because the sovereign is in severe macroeconomic distress. So the notion of the sovereign bailing out in these kind of situations is a moot point, because it's something else that if a sector explodes but the sovereign is still fiscally liquid, they can come in and bail out banks. Here it's, it would actually be a deep crisis, in the sense that you wouldn't really even have anyone. And a state bank is a lender of last resort, but there's only so much even they can do if there's a full-fledged financial sector kind of crisis.
And I know some of my listeners, because I've received similar comments when the state bank autonomy debate was going on, and we had a couple of episodes. We're saying, well, in this situation, Namoos, that's their thought. I can read it actually as the comment is going to come. The sovereign can print money. They can work with the State Bank of Pakistan and print money and bail everybody out. Explain to people how terrible of an idea that would be if you come to a situation where the sovereign has to do that to bail out the banking sector.
I mean, just think about the inflationary pressures, right? That is the main thing, because you can keep printing money, but then your inflation is going to go through the roof, right? So the notion of, I also hear this often, that the country is have we been hijacked by the IMF, and we can't borrow from the central bank, and the private sector credit is getting further crowded out now because banks have much more appetite from the government to borrow. I mean, so those points, I mean, in some ways I understand where they're coming from, but if you look about the long-term development of an economy, the role of the central bank, as in Pakistan, is price stability, right? So, but if if their role is convoluted with bailing out the banks and printing out money and giving money to the government, they have no control over the fiscal discipline of the of the government as is, and the inflationary implications are just going to be immense, right? So in Sri Lanka, for example, the central bank can lend to the government still, and look at their inflation. I mean, in Pakistan inflation is also high, but obviously because there are some kind of buffers, we're not obviously not. I think our economy, hopefully, I think is on its way to stabilization. But those are the kind of reasons why you can't have on tap money, printing money, because basically your prices are going to go completely through the roof.
And then people, I'll add to that, people talk a lot about the exchange rate sliding. In that scenario where you start printing money, you're looking more at, I would say, less of a Sri Lanka and more of a Lebanon type collapse of your currency's valuation. And then imported inflation is going to be through the roof on top of everything else as well.
Exactly.
For
an economy to function properly, everyone needs to stay in their lane and do what their mandate is. And there might be pain points when you adjust to that kind of, synergy. But I think that's important. All financial, agents need to be doing what their fundamental role is and kind of stay in their lane. That would be my main kind of understanding in this space.
One other thing that I've sort of followed and noticed over the last couple of years, in sort of like, what's the term? Pak econ Twitter, let's call it that, is this debate about the state bank's policies around turf and subsidized access to credit and, getting banks to, or encouraging or forcing banks to lend more to the real estate sector, et cetera. How have you viewed that development in terms of where the state banks tried to go? Because on paper, to me, it seemed like the right approach where they're trying to push banks to lend. But then when I've looked at people who studied the data closely, their argument has been twofold. One, that is basically going to the big guns, and it's being used for that. The other thing they've also argued is that, at least especially in the last few months, a lot of the private sector credit gains have been sort of inventory for booking inventory because of the commodity hikes. And so their argument is, yes, the state bank is pushing towards that, but essentially it's not going to the sectors that deserve it, in the sense that they're smaller, they need access to credit to scale, etc. How have you seen the push from the bank in the last 2 to 3 years, saying, hey, here's subsidized credit, lend to people who deserve it?
So, I mean, I believe you've had my colleague Gonzalo on your podcast, and he's done a lot of work on this. And so I think you've captured some of the main points. But he'll give it to you from an export diversification kind of lens, in the sense that they're not diversifying who's getting access to this fund. If I look at it purely from a kind of financial sector perspective, there's a couple of things. Firstly, number one is it's inflationary. That's one thing to keep in mind, which is something that the IMF has also had concerns about with the state bank, that the rates are much lower than benchmark rates. So it's contra to your monetary policy. So that's one side of it, but that's kind of on the macro side. The other side is this, that at the end of the day, I mean, what we always say, that the market needs to be, whatever comes into the market needs to be sustainable and needs to be market based. Interest rate subsidies are not necessarily, obviously, normally the best instrument. We think more of things like de-risking, to give some kind of a credit guarantee so that the price of the debt comes down. That is more aligned to kind of market realities and things of that nature. But I think that this feeds into the whole kind of other paradigm. There is an almost a big guns capture of this space, right? I think if when I gave you the number of private sector credit being 17% of GDP, I think about a fifth of that comes from refinancing schemes of the state bank. So the banks, it makes them even lazier. So whatever private sector lending they're doing, about 20% of that is coming from these kind of schemes from the government. So, I mean, if we want to build the discipline in the banks to price their risk effectively, to go out and look for clients, to diversify their kind of client base, it's not necessary. I mean, at the time of COVID, for example, globally we saw this. A lot of central banks, because it was a very different kind of environment. We wanted to keep the lights on in businesses. the economy, they wanted to make sure there was demand, productivity didn't increase. So there was a lot of this refinancing happening at that time. But now we're seeing the inflationary impacts of that in many countries across the world. So I think, so that's one thing. So to my mind, and this is the stance of the World Bank Group as a whole, and we've had these conversations with the central bank many times, that, we do understand that there is a role for development finance in Pakistan, especially given the fact that the government is a dominant borrower. There needs to be some kind of development finance institutions, whether it's an infrastructure bank or whether it's something, which is a wholesale financer that promotes investment towards kind of priority sectors. We just don't think it's the job of the central bank to do that. Their mandate is completely different. And whatever way that these schemes are introduced into the market should be in a way that is sustainable, that doesn't create bad lending habits, that isn't captured by a specific group. And it needs to be sustainable with very limited fiscal implications for the government. So, those are the kind of views, but we also do understand that because it's been so hard to move the needle on things in Pakistan, and exports being such a big priority, very fundamental to our growth model going forward. And we now do have an Exim Bank that hopefully will take on this role going further, and so hopefully things will change, but I think the central bank also now realizes that these schemes need to be perhaps managed outside of the central bank and need to be managed in a way which is more inclusive and more kind of market-based.
One last question on sort of the structure of this lazy borrowing sovereign financial nexus, as you described it, right? This is a thought I've had for a long time, is that the state bank cannot pursue, it can try pursuing price stability, but it cannot achieve price stability when the sovereign itself is not being prudent about their spending, because they're going to run gigantic fiscal deficits, and the bank will always be playing catch up in terms of trying to stabilize prices, but the price instability is coming from these deficits. What's your take on the fact that it takes two to tango here, right? The state bank by itself, when it raises rates, and people have this debate in Pakistan, this is cost push inflation, raising rates is not going to solve the problem. My argument to people is, well, the bank is trying to pursue its goal, and it's basically imposing fiscal prudence on the sovereign through the back door by making it expensive for the sovereign to borrow. And in the hopes that, by that will force prudence on the finance ministry, essentially. But if the finance ministry or the sovereign itself does not follow a prudent fiscal strategy, do you think price stability can ever be achieved just by the state bank doing its own thing and pursuing its mandate?
So, I'm not an economist, so please, everything I say in the economic realm, take it with a pinch of salt. I don't want to be misquoted, as the World Bank says. But I think, it's fair to say, I think that's absolutely true, that they cannot. There is a contradiction. We're even seeing it now. There's these open market, so there's these open market operations where the state bank is injecting a lot of liquidity into the market. At the same time, they're raising the rates. So again, you're kind of like, which again
is to our point about lazy banking, right? It's like the state bank is saying, here's some money on a certain rate, and then lend it back to the sovereign with a nice spread.
On a margin, exactly, on a margin, and you choose the margin. When we auction, you can choose the margin. So I think that's a very good point, because I think this is what the PDU, the special section that we wrote, this is what we highlighted. We said that there are fundamental structural problems in the Pakistani economy, which mean that in the medium to long term, in the short to medium term, I would say, we're not going to see the kind of intermediation that we would like to. The fiscal, deficit of the government, the very limited revenue mobilization, these kind of things, those, until the government has less need to borrow from the banks, the banks will keep lending to the government. And the state bank has tried to do things. They have this new regulation on taxes. If your advances to deposit ratios are below a certain point, you have to pay a higher tax. I believe in the new budget, there's also added, the government does try to claw back whatever profits they think they're unreasonably giving to the banks. But, this is a fundamental structural problem, until and unless the dependence so there's two ways that this can be done. Number one, either the dependency of the banks decreases, of the government decreases, so the banks look for business elsewhere and go and actively create innovative products and, finance the real economy, as it were. Or if failing that, if that's not happening, given that, these are fundamental structural issues, then financial inclusion is the way forward, because then you need to increase your depositor base, right? Then you need to ensure that you have a big, because even though the government's borrowing needs are immense, they're not infinite. At some point, if banks have a much larger depositor base, they will need to deploy it elsewhere, right? And those are policies that, state banks to be congratulated. They are making very, very big and strong efforts, especially in the digital space, through, upgradation of the payments infrastructure. I think they're leveraging the NADRA database quite effectively in terms of, minimizing KYC costs and onboarding costs and things of that nature. So I think failing the fundamental structural problems, I think, State Bank is wise in that they're trying to increase the pool of funds at least, so that at some point banks will have ample liquidity, and which they will need to deploy more towards the real sector.
Yeah, I think on financial inclusion, we've made this argument on the podcast a couple of times, is, Pakistan was the first mover on digital ID. India was not. But then India connected digital ID with digital payments through UPI and zero balance bank accounts. And it fundamentally changed the game in terms of financial inclusion in India, not only financial inclusion, but direct benefit transfers, because all of a sudden deserving citizens had access to zero balance bank accounts connected to their Aadhaar, and the Sarkar could basically look at that data and give you the benefits you deserved, and the leakages were plugged essentially, right? So they connected soil health cards to fertilizer subsidies, and all of a sudden fertilizer theft went away, or didn't go away, but it got cut down significantly, right? And in Pakistan, we have the infrastructure through NADRA, now through digital payments, to do that. The zero balance bank accounts is a sort of missing piece in the puzzle, but I think from what I've heard, they're moving towards that direction. But to your point about sort of, the state trying to claw its things back from the banking sector, I almost see this as like the US war on drugs, where if there is demand for drugs, the state can finance a war on drugs and try to say, okay, we're going to go after the supply side of this. But hey, if people in your country are demanding this thing, there will be supply, and there will always be supply so long as you don't deal with the demand, right? And that's the problem with the sovereign. If it's running 7, 8, 9% fiscal deficits, this is what's going to happen. And that's the structural problem we need to deal with. Just one data point that I was looking at yesterday, just to put things in perspective, because people a lot of times ask like agricultural tax. Dr. Halia Snen put up this slide the other day showing that agriculture contributes roughly 23% to GDP, while its contribution in tax revenues is 0.1%. And that's just not sustainable. You cannot have a sector so large getting away without contributing its fair share, right? So that's part of the fiscal base problem. But let's switch to how do we solve for this? If you were to sort of be given a magic wand and say, hey, pursue these policies for the next 18 to 24 months or 36 months, how do you begin going about solving this problem where access to credit is mobilized to sectors that actually generate sustainable growth in the economy? How do we go and begin that transition?
So, first and foremost, it's the bigger structural issues which cannot be resolved in 24 to 36 months, right? I think with agriculture tax, I think broadening the tax base is very important. With agriculture, I would add property tax. I think Pakistan is very underleveraged in their property tax collection. So whatever they can do to kind of increase own source revenue and the tax base, whatever. But those are the kind of broader, longer term agendas. In the financial sector, I think there's a few things that could potentially be done. So firstly, as you said, I think the NADRA database infrastructure, I have always said this, is world class. This is one of Pakistan's biggest assets, I would say. It's a digital asset, and it's not leveraged effectively, right? But as you said, we're seeing an increasing use of it and linking it to the banking sector through the telcos as well. A lot of these subsidy payments that were done as part of the COVID response to the households, they were done through the NADRA database and the telcos. Unfortunately, they were, I believe, cash transactions, but at least they've started understanding that this infrastructure can be leveraged for this kind of distribution of social welfare payments. There's talks at BISP and ASAS and all of these, I don't even know what's called anymore, to kind of bring in these kind of mobile wallets, leverage Rast, so there is that movement in that space. So I think the NADRA database and these new regulations around easy Asan wallets and these different Rast payments, it's a seamless peer-to-peer kind of transfer. This kind of thing, if we can kind of use that to increase the depositor base, right? Because brick and mortar banking is pretty much done, globally, so if we can use this kind of digital infrastructure to bring in money into the financial sector, I think that's something that should be prioritized in a very big way.
I would sort of add to your point, brick and mortar is done, and we've established in our discussion that traditional banks are lazy. So somehow we need to insert competition into this space to grow the deposit base.
Exactly. And that to me is kind of the future. And the policy makers seem to be cognizant of the fact. I think the one issue is obviously financial literacy. A lot of people don't understand, what Rast means, and they think easy paisa is too expensive. So there's a lot of work that needs to be done around awareness building in this space. But I think that's a huge growth opportunity. It also obviously can lead to formalization. Because going digital is not just, because for example, if I am a vendor, like in China, like you see those nano loans which are approved like in 2 minutes, right? And it's not that it's a formal business in the true sense of the word. It's just that because that guy has a mobile wallet, anyone who Alibaba's or whoever of the world, Ant Financial, I'm not sure who operates there, they have access to all of his digital transactions. They know how much money he received in the month in revenue and how much he paid, whatever their outlays were. Even if he's not a registered business, they can give him a nano loan because they can see, okay, this. So it's for access to credit, having that kind of a digital infrastructure footprint, even for the smallest businesses, becomes very, very important. So I think that is a huge growth opportunity. I think the microfinance sector in Pakistan, microfinance has, I think, 8 to 9 million borrowers, and I think the formal financial sector maybe has 1, if that. So they are a huge age, especially for ag finance. Now they're diversifying into things like ag insurance, housing also. So I think that's and what's happened in Pakistan, firstly, it expanded very quickly, but then it's kind of plateaued. And what we're not seeing is the product innovation, because a lot of the households are now graduating. Their needs those enterprises are slightly more mature. They need micro insurance. Or they need a slightly longer term loan, or they need some kind of specialist technical assistance to complement the loan so they can build their business, right? And again, the Pakistan Microfinance Network is to be congratulated. They are kind of working with the microfinance sector to work towards that end. Microfinance operating costs are very, very high. I think the average rate for microfinance loans in Pakistan is between 30 and 37% or something. And they say that's because 16% of our costs are operating costs. It's not the cost of funds. So there's opportunities to digitize that as much as possible. You don't need someone to go to a farm to give the cash and take the cash. Again, this feeds into the digitization thing. If you digitize a lot of those transactions, it'll bring down the cost. So if you can bring down the cost of lending in the microfinance sector, if you can diversify, again, that's a huge growth opportunity. I think venture capital in Pakistan is, risk capital, as we call it. We've seen a huge amount that came in over the last few years. We have young entrepreneurs because of the mushrooming things that are happening with the Rast and the payment infrastructure. And, so there is an ecosystem that develops around that in terms of e-commerce and, things of that nature. I think that's a huge growth opportunity. And then at the end of the day, when it comes to development finance, things like trade finance, infrastructure finance, housing finance, then there needs to be some strategic kind of thinking around how the capital markets can be developed better. So coming back to your first question. So the role of the capital markets is basically to raise long-term local currency. Banks, by definition, don't have long-term funds. They have a depositor base, and Pakistan, especially, most of their deposits are current accounts. It's not their business to give a 15, 20-year loan, right? Even though they're doing it, it's not their business to do it. There's a rollover risk and all of that kind of stuff. So the capital markets need to be developed. so that you have that longer term fixed rate funding for housing, for infrastructure, for productive investment. So those to me, so financial inclusion through digital, microfinance and leveraging digital again, risk capital and entrepreneurship, and capital markets. Those are the areas, if I were, given the charge of finance minister or governor state bank, I would, prioritize, especially in the short term. And obviously the structural issues remain, and they are something that, bigger brains than me can tackle.
I think the access to risk capital, particularly in the last 3 to 4 years, right, has changed attitudes. I remember my generation when, graduating from IBA or LUMS or heading back to Pakistan after studying abroad, the goal was, hey, I want to go work at Standard Chartered or Engro or Unilever or Nestle. This generation, younger people who message me asking for advice are like, hey, I want to go work at a startup. Or how do I succeed at starting my own thing and then raise money because I have an idea? I think that's amazing, right? And that potential, by giving access to more risk capital to these budding entrepreneurs or these newer firms, I think can be revolutionary in the 5, 10, 15 year. And yes, a lot of them will fail. That's the game with at-risk capital. But it's that attitude shift. I think there's something to be said about what's going on, and I think that will have an impact. On the sort of, where we go with things like financial inclusion and as others, I think we just need to insert competition. The traditional sector, I agree with you, is just too lazy, and we need to figure out a way to solve for that. And then maybe that leads to some level of innovation in this space, because the need for sure is there, right? But it's just that, as you said, the banks don't really feel the need to do that. And then finally, I would love your thoughts on this point in particular, that you have this need for long-term finance across the board, and that's what's needed to fund manufacturing industry, new industries, etc. But you've mentioned this, the real estate sector, for example, right? And the point I always make is that why would an investor invest in Pakistan when the returns in Plotistan are amazing? Because, you get a real estate amnesty scheme, no questions asked, the taxes are nothing. You get amazing returns just by trading on files for Bury a Town or Name Your Housing scheme, right? How do we solve for that? Is this just a tax and incentives problem from your perspective? Like, hey, if the state says, we're going to make sure that, for example, the city of Pune no longer raises 10x in property taxes in the entire province of Sindh, maybe that changes incentives and then tells people, hey, look at other avenues for getting your returns that you need, because the lazy way of real estate investment is gone. Or is it a bit more complicated than that? Because capital isn't going to flow where the incentives are. And my view is, well, it's not going to flow into the manufacturing space because Pakistan is amazing as an investment.
So, this goes into, if you look at Pakistan's growth model, it's consumption driven, right? Which is the biggest problem. Our investment is actually very, very low. Whatever growth we have is consumption, and our economy overheats, and then every 5 years we have a fresh crisis. To my mind, again, I'm not an economist, but I do listen to colleagues and read the newspaper, and I work a lot on housing finance actually in Pakistan. So I've studied the sector well. I think you have a lot of wealth creation that's happening in the real estate sector. So we're not really able to suppress demand in Pakistan. Like, you'll see like there's this, whatever this, the inflation, very high inflation, the rupee is, the lowest it's ever been. In this environment, you have people buying Audis and God knows what all, because they have bought a plot like 5 years ago that's tripled in value, right? So you have this, it's like lazy investment. So you have lazy banking, you have lazy investment. So it is very, very detrimental to many things, because it's the consumption-driven model. It's feeding consumption, and it's crowding out investment. So I do think that it's about the incentives, right? As you said, it's not tax effect. Like I've always said that there should be a tax on unbuilt up land. If you buy a piece of land and in 2 years you don't construct, tax it. There needs to be the capital gains tax in terms of, even on files, you should tax them. Any capital gains in real estate at some level, need to be taxed. And this space in Pakistan has historically also been very opaque, because, we didn't even know who owns the land. So there was the Benami law, which was passed, I think, which was a very, very big, breakthrough in the real estate sector, that you couldn't own property in anyone else's name. Otherwise, you and the person whose name you had it could go to jail for up to 7 years. So, I mean, that was a fundamental kind of shift. I don't know if it's being enforced, but, so these kind of, this until and unless this kind of very easy wealth creation in the real estate sector can be broken, you're not necessarily going to see, any kind of meaningful investment in product. No one's going to go to the capital market. No one is going to kind of, put money in mutual funds or things of that nature because, this is just easy. They're also very liquid, surprisingly. It's very easy to offload property in Pakistan. So it's most definitely an issue. And I think policymakers need to really, really think very careful about it because it's not just a source of it's not just that they're losing out on tax revenue. The opportunity cost in terms of investment is immense.
I fully agree. And I think this also connects to, at some level, devolution of power. Right? I'll give you my own example here in Washington. My friend's neighbor, the house was vacated and it was classified as a residential property, but it was vacated and no one was living there. And so the DC government's residential authority, which is the regulator for the real estate sector, sent an inspector, checked out the place, concluded that this was vacated property, and the property taxes on this property went up 10x. And the guy had to sell it the next day, right? Because the city's policy was you cannot buy a property and let it sit empty to accrue capital gains 10 years down the road because it's bad for the city in its economy. We need affordable housing and we need a vibrant housing market. So either you live in it yourself or you rent it out. But if you're not doing that, if you're not developing or conducting economic activity on this piece of land, your tax rate, there's a vacated tax law, it's 10x than the residential or commercial tax law, right? Which makes absolute sense. That's how it should be, even in a country like Pakistan. And it should be connected to local governments because they're the closest to the market action when it comes to real estate. So they should have the power to sort of figure out what's going on in their communities and determine how they raise the money to develop the environment around them as well. And I think we don't have that. It's a big missed opportunity. India is much better. It's not that India is amazing in that regard, but even just in terms of what they mobilize is just huge. And it could be a game changer for Pakistan as well, both from a tax collection as well as you said, from the economic opportunity cost point of view.
No, and we've seen it's London, for example. Londoners are priced out of the market now because, the Russians, used to be the Russians, the Indians, they have bought out all of central London for this kind of reason. And that's an example. There was this whole thing that there should be a lights out tax, that if a house is vacant, as you said, in DC, I think, but the lobbying was so strong. But it has not only, it has also the way a city urbanizes. It has problems of that nature, right? You have urban sprawls because people who are actually working and contributing economically to a city can't afford to live in a city. So which in turn has environmental implications and all of that kind of stuff. So it's a huge area. And if any policymaker is listening to this, please pay attention to this because this is a fundamental problem in Pakistan's economic structure.
I think the only thing that would happen if they start moving towards that is, it would actually even benefit newspapers because all the construction industry ads will come out saying how they're under threat because of this taxation measure. But that's just how it works in Pakistan. But Namoos, this has been a fantastic conversation. Thank you for sharing your insights. Before I let you go, what are 2 or 3 books that you would recommend people pick up and read? And it can be on any topic, doesn't have to be related to finance or banking.
So I actually went up to look for some books and I'm very upset to see that most of the books I've lent to someone and they haven't returned them. But one which I really enjoyed, so all of them are nonfiction and all of them have nothing to do with the financial sector, because that's not what I like to read, to be honest with you. Frankly, I've in this age of iPhones and all of that, I don't remember the last time I finished a book. But when I did read, these were the ones I enjoyed. So one is called On Human Nature by E.O. Wilson. It basically talks about evolutionary psychology. It basically talks about how things like, aggression or altruism or, how if you look at the way from hunters and gatherers we have evolved, these are kind of things that were part of our survival instincts. So it's very interesting in that sense. And one thing which I found most intriguing in that was it talked about it's taken like millions and millions of years for us to develop these character traits. But the world is changing so quickly now that a lot of them are becoming obsolete in the new kind of reality. So that to me was a very interesting book. So I highly recommend it, On Human Nature by E.O. Wilson. And the other one was this Status Anxiety by Alain de Botton. And this talks about, it's basically a critique of capitalism and how we all kind of buy into the rhetoric of keeping up with the Joneses, and historically where this comes from, and how it will be the downfall of humanity at large. Alain de Botton writes a lot of books on like love and literature, and I highly recommend his books. But the Status Anxiety is one that really struck with me.
Thank you for those recommendations, and thank you for your time. This has been wonderful. And, maybe when the real estate tax comes and some of the reforms we've talked about start happening, we'll have you on again to talk about how you see these. But in the meantime, keep up putting out research. I enjoyed the read. It's linked in the description below. And again, thank you for your time.
Thank you so much, Zaheer. Take care.